Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, July the 31st. It's the FOMC meeting day and we are going to get a rate cut of 25 basis points. But that isn't everything to talk about. Let's start out with across the pond. We got German retail sales coming in better than expected at 3.5%, expected to be 0.5%. Last month's number was revised down from negative 0.6% to a negative 1.7%. So the revision, 1 percentage point off from what was expected there. That doesn't really take away from that big headline beat there by 3%. It's still, with the revision, a beat of 2%. And this is something we were noticing out of Germany, was the fact that they were starting to show some signs of weaknesses or some chinks in the armor where we were maybe worried about them getting a little bit on the recessionary side of the curve. Well, this retail sales number really is a nice surprise, to be quite honest. I did not expect this number to come out better than expected there. Then we got French preliminary CPI coming in at negative 0.2%, expected to be a negative 0.3%, so slightly better than expected there. And then German unemployment change in line with expectations. We got CPI flash estimate out of the European region coming in line with expectations at 1.1%, expected to be 1%. Core CPI flash estimate coming in at 0.9%, expected to be 1%, so pretty much in line there. Italian preliminary CPI came in at 0.1% in line. Flash GDP for the European region in line with expectations at 0.2%. And then moving back over here to the United States, we got ADP non-farm payroll change coming in at 156,000, expected to be 150, so that's pretty close to being in line with expectations there. Last month's number revised up from 102 to 112, so nice revision there. Non-farm payrolls, that means people are getting hired. That is good. Then we move on to the Chicago PMI, which not very good reading here. We came in at 44.4, expected to be 51.7. Remember, PMI is Purchase Managers Index. That is a leading economic indicator. It's the purchasing managers of the manufacturing sector that are surveyed as to what their outlook is, how they are feeling about their purchasing of the inputs to the manufacturing process. So they're forward looking, right? So I need to plan well in advance of how I think the economy is going to be shaping up. And if I think it is starting to roll over or turn down, well, I'm going to be pulling back on my purchasing of the raw materials that go into my manufacturing process that will be deliverable in 3 to 6 months, let's say, okay? So if I see in 3 to 6 months it's not looking too good, I'm going to be pulling back on my purchasing and therefore my manufacturing process, right? So very forward looking there. And one of the first times we've seen it go negative or below 50 in quite some time. I think it's probably been at least a couple of years. It looks like quick and dirty, basically 2016 was May of 2016 was the first time or the last time we've seen that go into negative territory. It did go in, actually last month it went into negative territory, so that's 2 in a row. But before that, it was way back to May. Not looking too good. That's right. Last month's number came in just slightly in negative territory at 49.7. I was thinking it was closer to 50, but still a negative reading there. Not that great. We also have crude oil inventories coming in at a drawdown of 8.5 million barrels, expected to be a drawdown of 2.5 million barrels. That's 2 major drawdowns in a row. And the last one, we could have attributed it more towards the hurricanes in the Gulf. We didn't really get any of that. There shouldn't have been a whole lot of disruption, but we are starting to see rig counts start to nosedive a little bit. That's also kind of holding off on some of that production as well. All of those things coming together, I think demand is starting to increase as well, which is causing some of that across the board. But when we look over at the markets, we can see that's not really affecting crude oil. We've come back to those same areas of resistance that we've talked so much about in the past several months, I would have to say, where we are getting up in and around as we approach, let's say 60, which kind of, we can see the 60 line right there, but we have these two lines that are part of the Fibonacci extension that have acted as major support and resistance areas. Part of that is due to it lining up with the point of control, or the POC, that should be a P, which is this line right there. It's lining up with that, so it's more of the magnet pulling it back down to the point of control, and we've got a little bit of overhead resistance. We have to keep our eyes on that because of it coming to fruition so many times in the past. We have to expect that to be a support and resistance going forward as well. But you can see, got up to that 59 area, we started losing momentum. Now it's kind of sandwiched between $1 on crude oil per barrel. So that it's kind of stuck in a holding pattern here. And we've talked about this also. There is like an area of where perceived value is, and that is somewhere between 62 and 52. So there's a $10 range. Like I said, it can't go much below 50 because then we start pulling back on our production of the shale, and that limit supply should drive demand, right? Well, we started getting up into the 60s, and our economy really just can't support that type of level at this time in the economy anyway. All right, gold futures should be driving higher with the expectation of easy money, weaker dollar. We also have Brexit and a couple of other things going on that could affect the pound and some other currencies. Gold, generally speaking, is a flight to safety for currency risk, okay, or inflation. So a lot of people thinking to put their money into gold. Today is the day, though, so hopefully everybody's hedged up their position for the FOMC minutes that happen at 2 o'clock Eastern and 3 o'clock Eastern and 2 o'clock Chicago time. Is that right? No, sorry. 2 o'clock Eastern, 1 o'clock Chicago time. It's been a while since I've been in the Fed Fund futures. I used to know that by heart. I could actually tell you what the rest of the meeting dates were for 2019 as well. But those days are a little bit behind me, and dealing more in line with the stocks and how they're affected by those rates. All right, we've got VIX holding on to the teens, but not looking too good if you're a chartist. I mean, we've got lower lows and lower highs, so market looking to peel off to the downside, and I think that's basically because most of the sentiment out there is pretty bullish for the stocks. Aside from Europe seeing some weakness over there, lowering of interest rates here should hopefully hold off on a recession here in the United States. But I think that we are treading on some uncharted waters here, and it's going to be touch and go how this ends up. All right, NASDAQ in positive territory by about 23 points. The equity is being higher. That's another reason why the VIX is coming off. We've got the E-mini S&Ps up almost 6 points on the day, and overnight inventory pretty much flat. We came into this morning and got a bit of a sell-off, which kind of helped me out on my earnings trades, which were not looking too good. I mean, they didn't look too good yesterday as well, coming into today. I had this thing where I was going to come into the earnings season. I was playing everything to the upside. I was only going to sell puts because I think that we are doing much better than what everybody's trying to talk. Like, it seems like the market is saying the economy is not doing very well. We need this rate cut. I think the economy is doing just fine. I don't think that we need to spur these bubbles. And one of the things with cutting interest rates is going to spur spending and could spark trouble in the economy, I think. All right, but anyway, overnight inventory pretty flat, and we've kind of flushed all that out. It's just back and forth for the most part. But on to the earnings trades that I've done. When I'm doing my earnings webinars, I talk about covering these trades almost immediately off the open. I did, and lost track of this since I've covered these trades, and this is exactly why. You can see HES is blasting off to the upside. Now, one of the reasons why I did change my angle on HES is you can see that they usually start out pretty good on the day and then start selling off late in the day. So I wasn't too worried about the upside here, but and especially after they missed on the earnings. The thing is the whole market all started turning around after that first 15 minutes of the open. We started seeing some sell-off come off, and then, after about 30 minutes after the open, we started seeing more of a rebound in that last hour. So we can take a look at this, actually. If we break this down, we'll see it pretty good on the breakdown here. Actually, it's on the 15-minute chart because I was talking about that. When we opened up, you can see the market really blasted off, and then we started seeing some weakness. This was pretty much your only opportunity to get out of this stuff. As a matter of fact, I got out of my HES trade at like 6:58 or something like that, I think it was. I'll have to check the exact time. 6:58 was when I got out of the HES, and about 5 minutes earlier than that, I got out of my AMGN. But in this HES trade, I got really lucky and went into the August, which expire on Friday, sold the 64 calls in there for 37 cents, and I had to buy those back for 45 cents, and that was a lucky out. I'm glad to get out at that price. As you can see, it almost never looked back, really. I had an opportunity right on the open to get out of that, but could not get out of that any other way. It was a race to get out. And then in AMGN, very similarly, you had a chance to get out right on the open, and we can see we got a bit of a pullback here. I was chasing it right off the bat. AMGN has a tendency, again, kind of like HES, which is why I went with the short call. Comes in with a little bit more oomph after the earnings and then loses some of that momentum. Well, we lost the momentum on the open, and as soon as we started coming back, I was chasing this like I was falling over myself to try and get out. I had finally got out for a bit of a loss here. And August, I had sold the 182.5 calls in there. Originally for the AMGN, I sold for 64 cents and got out by $1.29 on that, chasing it out. It's probably much worse right now. But again, get out of these trades on the open. Sometimes I let them meld a little bit with, especially with earnings. If it's a loser, I'll try and play around with those. These two today, with the FOMC, the rate cut, and the market, the way it started turning around, I just pulled the ripcord on it. I don't want to take that kind of risk into this type of meeting because anything could really happen. So out of both of those trades, both for a loser, but anyway, it is what it is. So moving on with my life, and going to be checking out a couple more earnings trades. So check it out on Twitter at Wolfman's blog. I usually tweet those out if I'm doing a trade there, unless something crazy happens towards the end of the day. But we'll be taking advantage of those throughout the earnings. And that's about all I got for you guys, other than if you can't take that, take it easy.